Hey everyone, Mobileye Global has started 2024 on a rough patch. Its stock price down from higher than $40 per share to end the year to $26 per share as of this recording. That has a lot of investors asking, should I buy the dip in Mobileye stock? Well, that's the question I'll answer in this video, looking at the company's revenue, profitability, cash flow, valuation, and its prospects for the next 2 years to consider if this is a buying opportunity for Mobileye stock. So let's jump right in.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so I mentioned the price volatility to start the year, and you can see going back all the way to last year, the price action, it's down below its IPO price, $26 per share. Of course, Mobileye, owned primarily by parent Intel, is available for investors to buy as well. The company delivering products for driver assist technology, hopefully one day driverless technology, which I'm bullish on longer term, although shorter term, I think it's going to be long going indeed. Regulations are my primary concern. Even if the technology will be there for driverless cars, I think regulation will lag behind, especially in the US. I've been more bullish on driverless car technology in other regions, primarily China, because I feel regulatory concerns over there will be less constraining than here in the US. Laws and regulations tend to take much longer here in the US, the process much slower. I feel if the technology is available in China, I think they'll implement it much sooner than here in the US, but that's just speculation on my part based on how I've seen regulations evolve here in the US. Still, that doesn't have to exist for Mobileye to benefit. It's already benefiting from, parking assist, driver lane assist, right? Changing lanes and implementing pieces of driverless technology on its way to full implementation of driverless technology and the digitization of cars. It's needing to be more tech advanced, and that's going to benefit Mobileye, even if right now they're forecasting tough times ahead for 2024. This is largely due to an inventory surplus that surfaced in late 2023, mid 2023, working its way through the system, and then demand likely to increase, as we will see later in the video, in 2025. However, already the company's done a good job boosting revenue up to 2.1 billion. And that was up from around 1.5 billion around late 2022. Revenue growth has been solid for Mobileye. Near term, it's going to be under pressure, but overall, it's done a good job growing revenue. Additionally, in its brief history, Mobileye has demonstrated economies in scale. Economies in scale is one of the most desirable characteristics you can find in an investment. In the example I have created here, sales grow from 100 in year 1 to $115.76 in year 4, while net income more than doubles from $4.50 to $9.47 in year 4. This company demonstrates economies in scale. As its revenue grows, its profits grow by a larger magnitude. Not every company can achieve this kind of effective growth. Here's how it works. This is a typical categorization of an income statement of a publicly traded company. Cost of goods sold is what's called a variable expense. That means cost of goods sold is connected to sales. Other expenses like interest, general and admin, and depreciation are not connected to sales. You can see here depreciation stays the same at 25 whether sales increase or not. The same is true for interest expense. It stays the same whether sales grows or not. You can understand your interest payments do not increase when your sales increase. Overall, businesses typically have a mixture of fixed expenses that are unrelated to sales and variable expenses that are. When sales increase, the business leverages those fixed expenses, as we see in this example, and profits grow by a larger magnitude than the increase in sales. So now that you understand the importance of that metric, you can see from negative 6.5% in late 2022 all the way up to negative 1.59%. I often say on my channel, I don't mind when companies are losing money on the bottom line, as long as they're showing me progress towards profitability, and I'm certainly seeing that with Mobileye in its operating profit margin. I also want you to understand the cash flow from operations metric. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, the annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of percent annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. All right, so now that you've understood the metric, you can see Mobileye decreasing cash flow from operations to sales down to 18.95% in the most recent trailing 12-month period after bouncing up in early 2023. I suspect more headwinds in this metric for Mobileye as the inventory correction persists, and then later in 2024, starting in 2025, I suspect this metric will turn around for Mobileye Global. Now, I mentioned I will look at the prospects for the next few years, and here we are. For the current year, I mentioned it's going to be tough in 2024. Sales growth expected to be negative 8.46%, 8.4%, I should say, for Mobileye, and then to recover in 2025 with sales growth of 39.4%, a more robust rate of growth in 2025 and beyond for Mobileye. And then finally, I wanted to look at valuation, and Mobileye is currently trading at a forward price to earnings of 32.67, which is near the lowest this stock has been trading for since its IPO. So the near-term headwinds and the stock price decrease has Mobileye trading at an attractive valuation. So I would say, yes, this is a buying opportunity for investors looking to get in at Mobileye during this dip, and the headwinds are likely to persist. Be prepared for that. Tough times ahead for the rest of 2024, but the rebound is expected to be robust in 2025. So you could get yourself in here in 2024 to prepare for the rebound in 2025. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.